Have you ever wondered what the world's most powerful financial institutions do when they're nervous? Well, right now, central banks are quietly buying gold at a rate we haven't seen in over half a century. We're talking hundreds of tons of physical gold being moved from vaults in New York and London back to their home countries. Now, why would they do that? The answer isn't some conspiracy theory. It's not a wild guess. It's math. Cold, hard, simple math. Welcome to Bullion Signal, the place where we look at the macro signals to help you protect and grow your wealth. Today, we're going to walk through the powerful arithmetic that shows a major monetary reset isn't just a possibility, it might just be the logical endpoint of the path we're on. So if you're looking for a clear, data-driven perspective on gold, finance, and our economic future, make sure you subscribe to Bullion Signal. Now, let's run the numbers together. To really understand where we're going, you first have to get a firm grip on where we are today. And it all starts with this number, $305 trillion. That is the current total of all global debt. It's a number so massive it almost loses meaning, right? So let's put it into perspective. It's 336% of global GDP. Let me say that again. For every single dollar of economic value, every car, every coffee, every service that the entire world produces in a year, there are more than $3 of debt stacked on top of it. This isn't just a spreadsheet figure. This is the starting point. It's a global financial system under an immense, unprecedented level of stress. A level of stress that is, by its very definition, mathematically unsustainable. Now, as mind-boggling as that number is, you might be surprised to hear that this situation, it isn't entirely new. When you look back through the centuries, a clear and undeniable pattern emerges. From the Roman Empire to Weimar Germany, every time a society gets into this kind of debt predicament, a remarkably consistent series of events begins to unfold. It's a pattern that has played out time and time again, and it almost always ends the same way, with a complete overhaul, a fundamental reset of the monetary system. The question is, are we seeing that same pattern play out right now? So before we dive into that historical pattern, we really need to understand the cracks that are already showing up in our current system. The stress isn't just about how big the debt is. It's about what that mountain of debt forces governments and central banks to do to the money that's in your wallet and your bank account. And this brings us to one of the most important concepts you'll ever need to understand in finance. This right here is the heart of the matter: monetary debasement. It sounds technical, but the idea is brutally simple. It means making money worth less. In the ancient world, it was physical. A Roman emperor would take a pure silver coin, melt it down, mix in some cheap copper, and then stamp out a bunch of new coins. He suddenly had more coins to pay his armies, but each one contained less silver, so each one was worth less. Well, today, they do the exact same thing, just without the furnace. It's all digital. Central banks create trillions of dollars, euros, or yen out of thin air to buy government debt. The result is identical to what the Romans did. You have far more currency units in the system chasing the same amount of real stuff: houses, cars, food. And that relentlessly, silently steals the purchasing power from your savings. This is the engine that has driven every monetary collapse in history. So, what exactly is this historical pattern I keep mentioning? Well, it seems that every major monetary system follows a predictable four-stage life cycle. And once you learn to see this framework, you'll start recognizing where we are in the cycle. You'll see it in the news headlines, in the statements from politicians, and in the actions of central banks. So let's walk through it. Okay, stage one is the foundation. This is when a currency is strong, trusted, because it's backed by a real, tangible asset, usually gold or silver. This puts a natural limit on how much money a government can create. It enforces discipline. But then you get to stage two: expansion and debasement. A government decides it needs to spend more than it takes in, maybe for a war, maybe for massive social programs. That gold backing becomes an inconvenience, a restraint. So they break the link. That's when the debasement begins in earnest. And that inevitably leads to stage three, the crisis. This is where the public starts to feel the consequences. Inflation, which was once low, becomes high and persistent. People start losing faith in the currency. Foreign creditors who own the country's debts start to get nervous and begin to sell. The government finds itself in a trap, and its only answer is to print even more money, which just accelerates the crisis. And that takes us directly to the final act, stage 4, the reset. The currency collapses in value against real assets like gold. Paper wealth is wiped out, and eventually the system is forced to restructure, usually by relinking a new currency to a real asset once again. Now, I want to be very clear. This isn't just some academic theory. This is a roadmap that we can trace through thousands of years of financial history. The evidence is overwhelming, and it is written in the ruins of fallen empires. Let's look at a couple of textbook examples. First up, the Roman Empire. For a long time, the silver denarius was the equivalent of the US dollar today, the world's reserve currency. It was trusted because under emperors like Augustus, it was almost pure silver. But as the empire grew, so did its expenses, a massive military, sprawling bureaucracy, you name it. The emperors found it much easier to debase the currency than to raise taxes. They slowly, systematically reduced the silver content. And what was the result? Predictable. Runaway price inflation, a collapse in trade, and widespread economic chaos that directly fueled the political instability that brought the empire to its knees. By the end, the once mighty denarius was basically a copper coin with a thin silver wash. The pattern was complete. Now let's fast forward to a much more modern and terrifyingly rapid collapse. Weimar Germany in the 1920s. After World War I, Germany was hit with war reparations so massive they were impossible to pay. So the government was faced with a choice: default on their debts or fire up the printing presses. They chose to print, and the result was one of the most famous hyperinflations in all of human history. Just try to wrap your head around this. In January of 1923, a loaf of bread cost 250 marks. By November of that same year, that same loaf of bread cost 200 billion marks. Generations of savings, meticulously built up by the German middle class, were rendered completely and utterly worthless in a matter of months. And that brings us to our modern era, and to the single most important date in recent financial history, August 15th, 1971. See, the U.S. was in a similar bind. It needed to finance the expensive Vietnam War and Johnson's Great Society programs. So it printed far more dollars than it had gold in Fort Knox to back them up. Other countries, particularly France, noticed this and started showing up, asking for their gold in exchange for their dollars, as was their right. Faced with the prospect of an empty vault, President Nixon made a fateful decision. He unilaterally closed the gold window, severing the dollar's final link to gold. In that one moment, he officially moved the entire global monetary system into stage 2 of the historical pattern. The era of pure government promise money had begun. Now look at this number. At the very moment that Nixon took the golden brakes off the system, this was the total U.S. national debt, just under $400 billion. Take a good mental snapshot of that, because that number is our baseline. It's the starting line for the great monetary experiment, the great debasement of our time. And this is the U.S. national debt today, over $36 trillion. That is a 90-fold increase since the discipline of gold was abandoned. Let that sink in for a second. A 90x increase. This isn't just a number on a chart. This is the stark, undeniable evidence of 50 years of relentless, unchecked monetary debasement, all made possible by that single decision in 1971. So, if 1971 was the moment we officially entered stage 2, the most important question for all of us today is, where are we now? Well, when you look at the evidence objectively, it points very strongly to the conclusion that we are deep into stage 3, the crisis phase. And the symptoms that are showing up are exactly the same ones we saw in Rome, in Weimar Germany, and in countless other examples throughout history. So let's tick through 5 of the most critical warning signs. First, we have structural inflation. Remember when they told us it was transitory? Well, it's proven to be deep-rooted and sticky, and it's eating away at your wages and savings every single month. Second, foreign creditors are losing their appetite for U.S. debt. Major players like China are now consistent net sellers of U.S. treasuries. They are less and less willing to finance America's spending. Third, you see the rise of alternative power structures like the BRICS alliance. They are actively building new systems for trade and finance with the explicit goal of bypassing the US dollar. Fourth, and this is a big one, you have record gold buying by central banks. The very managers of the paper money system are trading their paper for physical gold. What does that tell you? And finally, number 5, the unsolvable debt trap. The interest payments on the national debt are now one of the government's biggest expenses, forcing them to borrow even more money just to pay the interest on the old money. It's a classic debt spiral.
This chart right here visualizes what that loss of confidence looks like in real time. It shows the US dollar's share of global central bank reserves. You can see that back in 2001, it was nearly 73%. Today, it's below 58% and falling. Now, it's not a sudden crash. It's a slow, steady bleed. But the trend is undeniable. This is what stage 3 looks like on a global scale. The world slowly, methodically diversifying away from a currency that is being relentlessly debased.
And this gets to the heart of the trap that policymakers are in. Think about every crisis we've had since we left the gold standard. The 2008 financial crisis, the 2020 pandemic lockdowns. What was the response? Every single time, it was the same playbook. Print more money, borrow more money, spend more money. They are literally trying to solve a problem caused by too much debt by creating staggering amounts of new debt. This is the definition of a system that has lost all control, a classic hallmark of stage 3. When you look at this trajectory, you have to ask yourself, where does this path logically end? Well, it ends at a point where the debt becomes truly unserviceable and public confidence completely evaporates. Historically, this is stage 4, the reset. And what's fascinating is that we can actually use simple math to get an idea of the potential scale of such a reset. This isn't about gazing into a crystal ball, it's about pure arithmetic. Let's run a quick thought experiment. For a long time, a conservative and stable monetary system was considered to be one where at least 40% of the currency was backed by physical gold. So let's take a broad measure of all the US dollars in existence. That's called M2. And let's ask a simple question. What would the price of gold have to be today for the US government's official gold reserves to back just 40% of the money supply? The math is shockingly simple, and the answer it spits out is over $10,000 per ounce. Now, let me be crystal clear about what this number means. This is not a market prediction for tomorrow or next week. It is the accounting reality. It is the mathematical price required to restore a credible link between the currency and a real asset. In a way, it's not that gold would be going up. It's that this number reveals how much value the dollar has already lost. And this really is the key takeaway from our entire discussion today. This historical pattern, it isn't driven by politics. It's not about being left-wing or right-wing. It's not driven by opinions or personalities. It is a system of inputs and outputs. If you continuously create more currency units than real-world value, and you accumulate debts that can never be repaid, the mathematical outcome is a devaluation of that currency against real assets. The laws of finance are, in that respect, just as cold and unforgiving as the laws of physics. So let's bring it all home. The very people who manage the global paper money system are preparing. They're physically moving their most important real asset gold back under their own direct control. They know this history. They understand the 4-stage pattern. And you can be sure they understand the math. They are positioning themselves for stage 4. So the final question this analysis leaves you with is this. Now that you see the same pattern and you understand the same math, how will you prepare? If you found this breakdown valuable, please make sure to like and subscribe to Bullion Signal for more analysis like this, and share it with someone who needs to see the bigger picture. Thank you for listening. Just a quick reminder, this content is for informational and educational purposes only. It is not financial or investment advice. You should always conduct your own research and consult with a professional before making any financial decisions. Your financial future is your responsibility.